Hello, good morning. Hello, good morning, everybody. By my time, it's 9 o'clock, and today's webinar is going to start. I would like to welcome everybody from the weekend into this new week, new and exciting week. We thank you for taking time to join us today for the first in our series of webinars. This is the first in a series of webinars on the financial services industry. And today's morning session is on accounting, financial reporting, and tax. My name is Kenneth Erikume, and I'm going to be your moderator for today. This session is being recorded, and the reason we are recording it is so that it will be available on our online platform subsequently. So if there are any instances where you miss out on something, you can always go back on our website and refresh. There are some ground rules. Automatically, as you joined, you would notice that you've been muted. Now, this was intentional, both from our perspective and for yours, to ensure that there's minimal disruption to the conversation. Now, you need to choose to join the session by the audio in your computer so that you can hear me clearly and you can make contributions. The reality is that we are all adapting to this new way of work. For me, this morning, my kids started school, but it was totally online. So it's a challenge for every one of us. So if there are technology hitches, please bear with us. We'll make sure that as much as possible, we'll try to resolve them very quickly. In the bottom right of your screen, you see a section called Q&A. Now, this Q&A section has been built into this platform to ensure that all participants can ask questions at any time. And you don't have to wait till the end of the session to ask a question. You can ask your question at any time. I, as the moderator, will pick up on them and at my discretion ask those questions from time to time. The way this session would go is the session would start immediately, and it will last for about 1 hour, 30 minutes. The opening remarks will be taken, and then we'll jump into accounting and reporting considerations. Then we'll look at audit matters, and thereafter we'll look at tax considerations. After the tax discussion, we'll then have the Q&A session where we would actually be taking feedback from the comments you've given, the questions you've asked, and we'll be directing it at specific panelists. At the end of the session, there would also be a survey. When you were registering, you would have filled some questions, and this was used to actually prepare a survey report, which we'll be sharing with you. And at the close, again, we'll come back and then we'll then close the session. Now, without further ado, I'm going to introduce Andrew Nevin to give his opening remarks. Andrew is the partner and chief economist for West Africa Financial Service and our West Africa Financial Services leader. So over to you, Andrew.
Thank you, Kenneth, for that introduction, and welcome to everyone. We're delighted to have you with us for the first of our COVID-19 FS industry webinars. Today's webinar, as Kenneth said, is on accounting, financial reporting, tax. So we have a great lineup. I just wanted to say a few words in my capacity as chief economist of PwC Nigeria. I think it's fair to say we go back to mid-February, this crisis, economists around the world were very slow to pick up on the economic damage from this health crisis. So even in late February, you have economists saying that this might knock a few points off global growth. Instead of China growing 6%, it would grow 4%. We had South African economists even in mid-March saying essentially the economy would be flat. I think it is apparent to everyone globally, and certainly us in Nigeria, that in fact we are already in a recession. This is not a big surprise when you realize that when you have these lockdowns necessitated by the health emergency, the lockdown essentially stops economic activity, and every person's spending is someone else's income. And as a result, we're seeing an incredible contraction of the economy around the world. There are some estimates, the government estimates from the UK, for example, say that the UK economy will contract 35% in the second quarter, which is extraordinary. This is the gravest economic crisis we'll ever experience in our lifetime. In the Nigerian economy, it's very difficult to predict how this will unfold because we responded to the health emergency. But we can already see a dramatic drop in economic activity around the country. Oil prices collapsed. You might have seen this morning the headlines. The U.S. oil price, the West Texas Intermediate, has reached about $14. And I think there's no question that I said we're already in a recession in Nigeria. The question is how deep this is. Now, we don't want to make a prediction in these circumstances, but the World Bank has already said that the economy in Africa will contract by 2 to 5%. And of course, we have the exposure to oil, so it's very likely that we will contract at greater than that rate. And of course, things may continue to deteriorate economically. So I'm sorry that I don't have any better economic news for us at the moment. I think it's incredibly important for all companies in Nigeria to be able to manage through this economic crisis. We've already seen, as Taiwo will talk about a little bit, there's been an incredible response from the federal government and from multinationals to do it. But let's not have any doubt, as I said, that this is the gravest economic crisis in our lifetime. So with that as a very dire economic introduction, I want to turn it over to my wonderful colleague, Belandly. So Belandly is the head of our CMAX group, so Capital Markets and Accounting Group, as well as a number of other things. She is also the head of our people at PwC Nigeria. So you can imagine in this crisis, for all of us, how critical it is to manage and take care of our people. And Belandly has been very busy on that as well. But we're very lucky to have her to talk about some of the critical accounting issues in the financial services industry arising from COVID-19. Thank you, Belandly. Belandly, are you there?
Yeah, I'm here. I'm here. Thank you, Andrew, for that introduction. And good morning, everyone. The truth about it is that even though things may seem dire and people not really sure what's going to happen post-COVID, we can plan ahead for it. There are a lot of things that we can do. However, before we are able to plan for it, we must, in a sense, know what's going on, what the impact will be to us. So this morning, I want to focus on the financial reporting impact. And there are a number of key areas that I want to talk about. Now, those key areas are around IFRS 9. For a lot of financial services companies and entities, your balance sheet is filled with a lot of financial assets, and by default, one of the greatest impacts you will find around that is looking at your assets. So the first area I want to look at is financial assets. We'll also look at other valuation of other assets. We'll look at the impairment of non-financial assets. Unfortunately, things like COVID-19, drop in oil price, forex devaluation, they're all things that we call trigger of impairment. So clearly, there will be some impairments that people need to look at. Then we'll look at interim reporting. For a lot of financial services companies, you would have done your December year end. Now, some may not have filed yet because we're still in April. So we'll look at one of the things that you need to look at disclosure-wise, and then going forward for your interim financials, we'll need to look at the considerations, and then a few other things that people may not necessarily think about that will have direct impact, but you will need to check as well. So looking at IFRS 9. IFRS 9 is the standard on impairment of financial assets. Now, one of the key things that we tend to look at with regards to IFRS 9 is something called significant increase in credit risk. We all know that when you look at your staging of your standards, you will need to decide and describe what you think or believe is an increase in significant credit risk. And a lot of times when things like an economic downfall sort of happens and items like COVID-19, there is an automatic sort of thinking that maybe this is an significant increase in credit risk, especially because of the fact that it will have repercussions for companies, counterparties, as well as customers. However, will the impact of COVID be a trigger for significant increase in credit risk? That actually depends. There are a number of things you have to consider. Some of them will be qualitative, so more sort of high-level things. Some of them will be quantitative. Now let's deal with the quantitative. So let's give an example with regards to moratoriums. So some of you may have had, those of you maybe in the banking sector or maybe in the fund industry, you may have had some of your counterparties or your customers come to you and ask for moratoriums. In addition, there are some government reliefs that have come together for certain government-funded initiatives, and they have asked you for moratoriums, which will change your cash flows. And, in some cases, there are payments with regards to change in interest rate. Now, for you to decide whether this is a significant increase in credit risk, one of the things that you need to look at on the quantitative side is when you look at the total cash flows going forward versus the total cash flows without COVID. So you compare what you have with COVID, without COVID, and then you also look at the contract, the original contract you have. You need to decide whether this will be an extinguishment or it's just a modification. So that's the sort of first level. So if you think, and you've done your calculations, and you look at the impact and you see this as an extinguishment, it may actually be an increase in significant credit risk for that particular contract or portfolio. Now, I know some people will be like, that's harsh. It's not their fault. This is going on. COVID is temporary. But the standard also sort of indicates with regards to the 10% threshold. So in some cases, if you look at the cash flow changes and you apply the 10% threshold where you compare the changes to the contract based on the new realities versus what it would have been, and there's less than 10% difference. That can be seen as a modification. But you don't just stop there. You will need to consider other credit risk indicators. Now, what are the other credit risk indicators you might look at? What's happening with the business of the counterparties? What happened with their credit rating? So, for example, if the counterparty is in the oil industry, we know that they're going through a difficult time. So, what does that mean? There are quite a number of things that you will need to look at with regards to that. So, for example, if your the projections or the cash flows of that particular industry, generally is changing, you will need to then look and say, are you going to downgrade the individual or the counterparty? Would this really be an increase in significant credit risk? All these things you need to factor in. What about interest rate changes? What about oil prices? What about other economic factors like inflation rate? So there are a number of things that you need to do. Another thing that you mustn't forget is the fact that IFRS 9 requires that we have the 30 days past due for stage 1 and the 90 days past due for moving from stage 2 to stage 3. Just to say, a lot of the things I'm saying, I am assuming a number of people have a background of, the requirements of IFRS 9. So I'm talking from the basis of that there is some basic knowledge about the requirements of IFRS 9. Apologies for those who are not aware. So with the 30 days past due, clearly the moratoriums and the government reliefs that are given will, unfortunately, cause issues for that. However, you can rebut this assumption. Now, to rebut it, with regards to some of these moratoriums, you must have it documented. It must be part of your policies. So one of the things you also need to look at as an entity is make sure that in your policies that you have updated what the requirements are for yourself. So if your policy is to look at other factors apart from the factors affecting the particular counterpart, so looking at external factors in determining increase in significant credit risk, you can also sort of decide based on these quantitative and qualitative factors that maybe COVID-19 effect is not an increase in significant credit risk. But the truth about it, we also know that 3-4 months down the line, even after the disease itself is gone, there might be other repercussions that we'll look at on the economy. So please, bear that in mind. For a measurement perspective, of course, the measurement of expected credit loss doesn't change. However, you do need to consider certain inputs that you would have had for some of your modeling. So modeling, think about the macroeconomic factors that you have used. You will need to redo them. You need to recalibrate your models based on the new realities. You will need to consider the fact that you have to look at the scenarios. So under IFRS asks for at least 2 scenarios. In this case, you might want to do 3, looking at the best case scenario post-COVID, worst case scenario post-COVID, and maybe a mixture of both. You will have to look at this. You may have to look at your collateral values, the collateral that these people have given you. The truth about it is there will be a certain devaluation based on things like interest rates. Interest rates will affect the fair value of a lot of assets, by default. It will reduce it. Things looking at time value of money for certain debentures and some other things that you need to look at. Of course, cash flows. So if people are revising their cash flow estimates, you will of course need to look at that. For some of those POI, CBN type loans, a drop from 9% to 5% for some of them is quite significant in a sense. So you will need to look at how that would affect your ECL models. The other thing in this case is the fact that when you are doing some of these calculations, you need to look at the fact that am I doing it as an agent of the government, or am I doing it as a principal? So if the government, in some cases, a lot of banks are used as agents. So a lot of times the banks are the ones that do the assessment for the government, and then the money comes from the government, and the banks now put certain margins on it. You will need to look at the effect on your income as well for some of these margins as well. Another thing is, there are a lot of assets, maybe when you look at your FGN bonds and some other receivables that you may have considered low risk. The truth about it is that with Nigeria being downgraded, some of you who have got international affiliates, who have got bonds listed abroad, the truth about it is that the international community and the analysts will be looking at what you're going to do about that. Because now that government is looking for liquidity, there are a number of FGN bonds, T-bills that will be issued, and interest rates are likely to go up because governments are looking for liquidity. When that happens, it's assumed that the value of some of those fixed interest securities will also go down. So you will need to also look at the effect of this and what expectations are around it. But there are opportunities for hedging. So, with all the things happening, you might decide to do some hedging. And if you are going to do, you will need to reassess some of your hedging instruments, what you're doing, and find out whether your hedging relationships currently work based on the current realities. One other thing with regard to hedging is the fact that you must have documented the risk that you're hedging. So you have to have a hedging strategy in place, hedge your risk, and also if you want to do hedge accounting, there are a number of principles that you will need to look at and make sure that you adhere to some of these principles. So that's a quick sort of summary with regards to IFRS 9 impairment impact. There are quite a number of things that are intricate, but of course, we don't have a lot of time to go into detail. But hopefully that gives you some ideas. So I'm going to move on to valuation of other assets. Now, I have talked about this a little bit earlier on, but what I want to focus on is the fact that when you're valuing your assets, of course, IFRS 13 is a fair value standard that sort of talks about how you fair value some assets. Now, more than likely, because of the way the market is moving, you might have a situation where certain asset valuation fluctuates quite significantly. So you might need to look at some of the market inputs and cash flows that you are using. You might need to revise your cash flows around this, the interest rates that will affect. If, for example, you are looking to do a business combination or a certain deal, contract that you want to go into, you will need to look at the estimates based on, current realities. Even some of your subsidiaries, associates, a lot of them may have had even yourself, you may have had your market capitalization change so that your share prices have dipped. And when you have that situation, these are all triggers of impairment, and you will probably need to write down some of these assets. And if you decide not to, you will, of course, need to document the reason why. If this is happening to you, more than likely it will be happening to your counterparties. So you will need to look at some of the collateral values that you have. Please do not forget the disclosures that are expected in financial. So IFRS 7 is the disclosures around risk management, around some of these valuations and market risk disclosures. Now you of course need to put in additional disclosures around sensitivities, because the sensitivity of whether it's a forex, whether it's oil price, whether it's the fact that COVID has had other rebound effects, you will need to put those in there around your fair value. You may find that some of your original level 1, level 2 type fair value assets may be downgraded to level 3 because of the fact that the inputs you're having to use to make sense of the valuation have changed. And so because of this, you need to put the impact of this in your financial statement. One thing you have to know, as you are knowing the story around COVID and the impact to you as an entity and all those around you, you must be able to tell the story and plan the story and tell the story, because a lot of people, so I'm sure a lot of you would have seen publications like FRC, CBN, other stakeholders, your shareholders, they all want to know what's going on. So it's as report, as preparers of financial statements, you all have the responsibility of making sure that we put in the appropriate information in there to help people make sense of what is going on as a result of the impact of COVID. Of course, don't forget investment property valuations as well. So some of you that may be carrying your investment properties in other entities, and you're carrying them as fair value, instead of cost, you will of course need to revise these as well based on current realities. Okay, so that's all around on financial assets and non-financial assets. So as I mentioned earlier on, COVID-19 is a trigger for impairment, and unfortunately, you will have to carry out an impairment assessment, even in your interim financial statements, interim reporting. For those of you who haven't done that yet, you will have to, because as of December, the impact of COVID was still minimal. It didn't affect us in Africa. But now it does, and so you must carry out impairment because it is an impairment trigger. So the downward side of the market, its effect. Don't just focus on things like your property, plant, and equipment. You will, of course, need to look at your leases as well. You will need to look at all your associates, all your subsidiaries, and other, non-financial assets that you will have that's on your book, tangible assets, goodwill. Because of COVID, you may have a situation where your cash-generating unit, so that's the unit that you use to test the impairment of goodwill, these may have to be modified because of the impact of COVID. IAS 36 gives clear guidelines of what you can do in this respect. Unfortunately, if you have done a recent business combination or you have goodwill on your balance sheet, your goodwill more than likely will have to write down. And once you write down goodwill, you cannot reverse it. Even if at the end of the year, things improve and you see an uplift, unfortunately, you cannot write it back. So that is one thing. So if you take the hit now, you cannot write it back later, even if it's temporary. And unfortunately, you cannot make a decision and say because COVID is temporary, you don't want to take the hit now. You will have to, do that. And I'm sure the auditors will have something to say about that. As we are looking at all this, it's important that you also, from your own point of view, when you're looking at your entity, looking at your budget and your forecast, please don't forget to, of course, look at the impact of COVID based on the various scenarios. So whether it's the worst case scenario, best case scenario, or a bit of both. So at least it can allow you to plan and put things in place to allow your business to still thrive in this situation. Even things around quality of earnings and cash flows available to you as an entity. You mustn't forget all these things because at the end of the day, it will help you make the right business decisions about where your spending should be or where spending costs should be or where you should need to invest now. Because even though there's COVID-19, I'm sure there's still quite a number of opportunities available out there where people can take positions to, because there are some depressed assets around. So people can take certain positions now, which will yield fruit later on. Okay, so now I'm going to move to interim reporting. Now, for those companies that have not filed their December year end, or maybe they have year end other than December, maybe January or February, it's important that you remember that you will need to have a subsequent event, quite a detailed subsequent event note, so for balance sheet event note, on the impact of COVID. Now, this will be about, you have to put things like about the nature of the impact. You have to quantify the impact. So if you have an idea of what you think the quantified effect will be, please, you need to put that in there. You will also, if there's an impact on going concern, you may find a situation where certain entities cannot prepare their financials on a going concern basis. And you will need to prepare the financials on a different basis, whether it's a liquidity or breakup basis, which is different from a going concern basis. COVID itself for December 2019 financial statements is what you call a non-adjusting event. So we wouldn't expect you to go back and then completely change your financials because of it. However, you will need to put in disclosures around COVID. Now, for those who are doing March interims and are doing March interims and are doing half-year interims, there are a number of things you need to bear in mind. COVID is something, something like a COVID is something called a discrete event. So you will need to understand that even though you are preparing your financials, on a fair basis, you also have to understand that management principles at the December year end will still be the same. So you cannot now start picking and choosing, what you want to do. But please ensure that you put in the appropriate disclosures around whether it's segment reporting, all your risk management reports, additional requirements by the regulators as well. One more thing that I want to just highlight on this particular area is regards to possible breach of loan covenants as a result of your ratios being breached temporarily. So in cases where maybe certain assets are depressed, it might have affected some of your ratios. Please have a look at some of your loan covenants, your lease covenants as well, to just make sure that you haven't breached any of it, even the regulator information as well, so that you can do that. So this is my pretty much my last slide. So there's just a number of other areas that I'll just touch on. Things like share-based payments. Please have a look. You won't have share payments to employees or management or directors have been affected. There might be some dilution effect because now that COVID has affected market capitalization. Think about warrants. In some cases, but unfortunately, some of you have to do some restructuring or layoffs. You will have to look at the valuation of restructuring provisions, which will need to go in your interim financials. Think about your outstanding contingent considerations and liabilities, which you may have, and you will have to look at the fair value of this item. Financial guarantees that you may have, you will need to look at this. In some cases, the government relief program that some of you may have, you may have to look at the impact of IS 20 on it, whether it can be seen as an other income to you or a charge to equity. Sensitivity analysis around maybe certain curtailments. So those of you might have defined benefit scheme, you might need to look at the valuation of this, your plan assets, sensitivity analysis around this. As mentioned earlier on, there might be some lease modifications as a result of COVID that you will need to look at. Things around the impairment of your right of use assets. So that right of use asset is also another asset on your balance sheet that you will need to look at. And then finally, around extensive disclosures that will be required for many stakeholders as well that you will need to look at. And don't forget the requirements by the regulators. CBN has requested that they want to report before the end of the year on the impact of COVID. Let's not forget that FRC has issued a few things as well. ESMA, for those of you who have European listing, ESMA has required asked for some additional disclosures that they were expecting for financials, and the IASB as well, who are the issuing body for IFRS. Let's not forget their requirements as well. So, just to end, we talked about all this. Do a thorough assessment. You might need to recalibrate your ECL model. Don't forget to carry out a valuation exercise to look at the impairment of both your financial and your non-financial assets. You may need to stress test your balance sheet, all your entities, to make sure that it can stand the test of time. And then, of course, don't forget all we mentioned about the incorporating the interim reporting consideration. Okay, so that's all I have to say. I'm now going to hand over to Sam Abu, who is head of our financial services in Nigeria and who is an audit partner, sort of talk about some of the things that auditors will be looking for at this time. Thanks for listening.
Thank you very much, Bolanle. Good morning, everyone. Hope you're all doing well and keeping safe. It is amazing how much the world has changed in just 2 months. From a PwC audit perspective, we're doing a number of audits for instance, for December 2019. It's quite interesting that the ones we completed earlier this year in 2023, you completed the 31 December 2019 audit in January. It was business as usual from an audit perspective. We've done our audit, we just issued a report, and everybody is happy and going away. our December 2019 audit that we're completing about now. It's amazing how much the world has changed since then. And we're requiring significant disclosures around subsequent events. We're requiring assessments of going concern. And many times I have my clients ask me, but this was 31 December 2019, why are you asking us to do so much now? But that is how much this COVID-19 issue has affected financial reporting. So you have, for instance, in the same industry, companies in the same industry issuing financial statements, one for the same period, one has significant disclosures around COVID-19, the other has, just simply because one issued its report or completed the audit a month later than another one. So those are the kind of things that you will be dealing with as we move forward into 2020. I just want to highlight a few things or to add a few comments to what Bolanle has said from the financial reporting perspective. The audit obviously is a part of your financial reporting. Everything you're doing, everything that Bolanle has just talked about are the things that will ultimately be subjected to an audit. And I think it's quite important that as you are doing all of these assessments, that you are addressing the issues coming out of COVID-19, you have at the back of your mind that these are going to be audited, they're going to be challenged, you're going to have extensive conversations with your auditors about it. From an audit perspective, it's quite important that you have the documentation right. As much as possible, involve your auditors early. It is okay to call up your auditor and bounce ideas off them. So ask their input around many of the things that you're having to deal with. Most of us have never, I think at the beginning, and Nevin said it, we probably would never experience this in our careers again. This is a truly black swan event. You're not going to see, hopefully, we're never going to experience something like this again. And it's quite important that you document in detail all the judgments and assumptions and projections that you have used to prepare the financial statement. They will be challenged by your auditors. Be ready for them to be challenged by your auditors. I'm already having this kind of conversations with my clients, and so you can expect the same as you go through, whether it's your interim audit or your final year audit in the next few months. So it's very important to start the process early. Judgments and assumptions, accounting estimates are inherently very difficult to audit because they are not transactional. They are subject of very high degrees of estimation uncertainty. They require a lot of management judgment and assumptions. So these are areas where there is an inherent difficulty in the ability for them to be audited. So you should be having very serious thoughts around the corporate governance processes around the decisions you're making, the assessments you're making, the judgment and assumptions that you are building into your models that would produce the numbers that go into the financial statement. So a couple more things I just wanted to add. It is very likely, it is almost certain that the impact of COVID-19 for those of you who are public interest entities, which I believe most financial services would be, the impact of COVID-19 is very likely to feature in the audit report as a key audit matter, either directly as a standalone key audit matter or in the manner in which it affects some of the financial statement line items that Bolanle has talked about. It might be a loans, it might be contingent liabilities, possible there might be actuarial liabilities. So it is very likely that it will be a key audit matter. Because it's a key audit matter, it will require a lot of audit attention because that is what key audit matters are. So you have auditors will require a lot more evidence to arrive at the conclusion that they're going to document in the key audit matter. You're also going to probably have more conversations around going concern than you previously have had. It is quite, in my experience, this is usually a difficult conversation to have because the auditor will ask management, I want an assessment of going concern. You need to demonstrate that the going concern basis of accounting that you are using in preparing your report, your financial statement, is appropriate. In this time, those are the kind of assessments that you require to perform. You need to demonstrate that. You need to do your budgets, your projections, and show the assumptions you use to reach that conclusion. This pandemic affects different industries in different ways. It's very likely that you might believe that for financial services industries, it might not affect you, but nevertheless, you'll be required to do a significant review and assessment of going concern to the extent that it affects you. And where that conclusion is that if there is a material uncertainty, you would be having the audit report might reflect that in the form of an emphasis of matter. That is, we expect that for most of our clients, for most of players in the industry, whether it's banks, insurance companies, asset management companies, what we're seeing at least is preliminary. We do not see that a lot of companies would have material uncertainty arising from going concern, but that has to be demonstrated. So the key takeaways for me, or there are three things I want you to take away from this. First, we should start early. There's not enough time. A lot of you still have your financial reporting timelines unchanged. A lot of the clients I'm talking to or contacts we're talking to in the industry say, my calendar hasn't changed. I still want to report at the same time, whether it's my quarterly report or my half-year report. The calendar hasn't changed. But there's a lot to do over and above what you've previously done. So the key is to start early and involve your auditors early. Second thing to take away is to document. A lot of what you've heard from Dr. Bolanle requires you to document your thinking, document your assumptions, document the basis for the judgment that you've reached, because those are the kind of things that the auditor wants to see. Those documentations must follow proper governance processes within your organization. If it's the board committee, a management committee, or a subcommittee of the board, those governance processes must be adequately documented and evidenced. And finally, as much as possible, involve your auditor. At the end of this call up your auditor, have these conversations. Where you need support, ask them, ask consultants to help you. So those are my comments, and at the end of the session, any questions relating to this, we're happy to take them up later. So at this point, I'll just hand this back over to Kenneth to move forward. Thanks, everyone.
Thank you, Sam, for that insightful comment on the audit considerations in relation to COVID-19. And thank you also, Bolanle, for the insightful session. I noticed that people have questions, but they are not familiar with the platform. So if you look on the bottom right of your screen, you will see a section marked Q&A. When you click that, it drops down, and then a dialog box opens up which says select a question and then type your answer here. Within that box, you can type your questions, and it allows you about 256 characters. Once you type in your questions, you have to click on send. So click on send and we'll get the questions, and we are aggregating all the questions at this time. So if you haven't had a response to your question, we're just deferring it to the Q&A session. So we're doing that. So please, if you have questions, and even if it's comments, please place them in the Q&A box and send them across to us. And thank you very much for your participation with regards to that. The next session would be covered by Taiwo Oyedele. Taiwo is the Fiscal Policy Partner and West Africa Tax Leader at PwC. He's an author, authoring several publications, and a contributor to the annual Doing Business report of the World Bank. As you would have noticed, he's many times on television programs, radio programs, and online media. and he's a member of the ministerial committee that drafted the 2017 National Tax Policy and supporting the Ministry of Finance with regards to the 2019 Finance Act. He's the president of Impact Africa Foundation and a guest lecturer at the University of Lagos, Babcock University, and Lagos Business School. He's attended several institutions, tertiary institutions, including London School of Economics, Yale University, and Harvard Kennedy School. So I'll just introduce and welcome Taiwo to take up the tax considerations.
Thank you very much, Ken, and welcome again to our participants. Thank you for joining us today. So in the limited time that I have, I'm going to be speaking about the fiscal policy responses and tax measures by government so far. And of course, the subline that I have there is navigating the path never traveled. Like Ken mentioned, and also Andrew, this is not something that we had done before. So therefore, we have to learn as we go along and do so in a very efficient manner so that we can at least, get through this period with least pain as much as possible. So my outline will be to quickly do an overview and give the context in addition to the economic analysis that Andrew provided at the beginning of the program. And then I'll look at the key challenges for businesses. Then we'll look at the fiscal policy responses and the tax measures introduced by government. And we then look at recommendations and closing thoughts. So by way of the economic context and an overview, as of this morning, we saw some reports saying that the price of crude oil per barrel is as low as $15. And I listened to the DMD of NMPC, a couple of weeks ago, saying our average cost of production per barrel is somewhere between $17 to $22 per barrel. So technically, Nigeria should just stop producing, and that's what it means. But this has a lot of consequences for us. Even before COVID-19, Nigeria had challenges, both in terms of economic challenges and also in the fiscal space. Our growth was very, very low, lower than the growth in GDP, which meant that our economic growth was fragile, and then there was rising poverty. Revenue was low, budget deficit was high, and debt was rising, both at the federal government level and also at state level. We have high unemployment rates, and our youth feel like they do not have equal access to the limited opportunities that are available, particularly in the public sector. There's insecurity, Boko Haram, kidnapping, internet scams, and Nigeria became the poverty capital of the world. Our infrastructure is not where it should be, particularly when it comes to electricity and transportation, but even also in the other area. In terms of competitiveness and the ease of doing business, we do not rank well, even though we need to acknowledge that some gains have been made in the recent past in terms of climbing up to, say, 131 on the ease of doing business. But really, we should be talking about Nigeria in the top 20 if we really want to move the needle. There's also low investment in human capital development, and this is increasing our vulnerability, particularly if you think about education and healthcare. And one of the reasons why this time can easily be very difficult for us is because we haven't invested well enough in healthcare and also education. So what are the key challenges for businesses? Now, businesses, you would see from this slide, they sit in the middle of a lot of challenges. We conducted a survey about 2 weeks ago, and then we asked business leaders, executives, over 500 of them, that participated in a survey where we had almost 3,000 respondents. And their top 3 challenges were, number 1, in that order, liquidity, availability of cash to pay your bills now. Number 2 was safety of personnel. 3 was infrastructure to work from home. And the other challenges were around sales and distribution, working capital management, and cost reduction. I know that we have a lot of CFOs on this call. So when it comes to issues of working capital management, cost reduction, liquidity, you see a lot of these challenges that businesses are facing rest on the shoulders of the CFO to figure out how to deal with them. And nobody should be under any illusion. These are not easy problems to deal with. I'll then move on to the fiscal policy responses and tax measures that we're seeing from government. And there have been quite a number of them. So the Minister of Finance, Budget and National Planning, a couple of weeks ago announced a number of measures. So what I've done is to put them into about 4 buckets. The first one is COVID-19 Crisis Intervention Fund, essentially establishing a 500 billion naira crisis intervention fund that will be used to upgrade facilities in terms of healthcare, but also to fund special public works program that is expected to generate about 774,000 jobs. That's average of 1,000 per local government across Nigeria. And then to put in place appropriate governance structure for the management and reporting of donations to the COVID-19 fund. Then the next category of interventions is what I call sub-national support. Because our states in Nigeria, many of them, even before now, could not pay minimum wage. Many of them were owing their IGR very low. So that problem has now just been amplified. So what government is going to do, one of the measures, or a number of the measures include the drawdown on World Bank facility, and then some other borrowing. All these borrowings put together come to about $6.9 billion. This one, FG, the federal government is making available about 102.5 billion resources for direct intervention. This was how the NCDC got about 6.5 billion and Lagos got 10 billion, which I believe they would also increase later on. Now that we have this pandemic in so many states across Nigeria, $150 million will be withdrawn from NSIA Stabilization Fund to support the FAC of June 2020. The amount of money that is needed to fund recurrent expenditure in Nigeria is around about over 600 billion naira FAC monthly. So it's projected that FAC will be as low as 400 billion. So to augment that, this money will be withdrawn from the NSIA Stabilization Fund. A number of people have been asking what happens to April, what happens to May, why are we starting from June? But hopefully maybe June is when government considers it will be so difficult to cope. Debt and interest moratorium for states on FG and CBN funded loans to create fiscal space for them. Then the next category of interventions are to do with the budget and how we fund the budget. The budget benchmark for crude oil per barrel has been revised from $57 to $30. Questions are now being asked whether $30 is even realistic and not too optimistic. The production per day is down to 1.7 million from 2.18. And here is one of the reasons why it can become so complicated. On one hand, we are hoping that there will be a deal by OPEC Plus to cut production so that at least supply will come down and then price will go up. But then if you do that, and let's even say the market responds and prices go up, then your volume will go down, which means Nigeria cannot realistically even produce up to 1.7 million barrels per day. So this is going to be a very difficult time to manage fiscal-wise. Then I spoke to the question around borrowing externally. But government says there's no intention to negotiate any terms of formal program with the IMF. I know Nigerians are concerned about that. And then there's a downward adjustment of non-oil revenue projections on the FRS, customs, and privatization proceeds. So the Budget Office is revising the MTEP as well as the Appropriation Act of 2020. In terms of tax reliefs and allowances, The Finance Act of 2019 already has a number of provisions to take care of particularly small businesses and the vulnerable, including exemption from companies' income tax, including not charging and not registering for VAT. But these are applicable to small companies with turnover of less than 25 million in a year. Of course, no stamp duties if you transfer money that's less than 10,000 naira. And then the exemption list for basic food items was expanded. And also now there are questions about, are you not also further exempt, pharmaceutical products and equipment that you need to tackle COVID-19, ventilators, face masks, and the rest of them. And government will try and shore up the hazard allowances payable to health workers, starting with the federal government and then encouraging also the states to do the same. This one might interest the private sector. Government is planning to make all donations under COVID-19 intervention fund to be tax deductible. So that would be good. Although we're still wondering what happens to donation by individuals, because what the Honorable Minister announced is only to do with companies under SITA. More importantly, there will be coordination. The Economic Sustainability Committee that is led by the Vice President will coordinate the actions and activities of the Central Bank, Ministry of Finance, Budget and National Planning, Petroleum Resources, Ministry of Health, Industry, Trade and Investment, because to be honest, without this coordination, this problem will become even more difficult to manage. So that better coordination is important, not only at the federal level, but I would also want to see, for example, coordination with the subnational. So we have tax and other measures. FRS, granted extension of filing returns for VAT, for companies' income tax. Some tax audits will be done online. LRS granted extension for 2 months for filing of personal income tax returns by individuals and companies for their employees. And then for the FCT IRS in Abuja, they granted extension for 3 months. And a number of other states have also done 1 or 2 things. The National Assembly has 2 bills. All 2 bills are by the House of Representatives. One is the Economic Stimulus Bill, which seeks to try and help Nigerians deal with this time. But unfortunately, if you look at the breakdown of the interventions in that bill, they don't go far enough. For example, for job protections, the bill says you get a rebate of 50% of the PAYE you have paid against your income tax. So imagine someone who earns about 100,000 naira per month. So their PAYE is somewhere around maybe 6,000 or even less. So the 50% of that is around 3,000 naira. Nobody will keep an employee that earns 100,000 naira per month get 3,000 just because they'll get 3,000 naira back from government. So it doesn't go far enough. Then there's the FARA of mortgage payments, but this is only applicable to people who have facilities with the National Housing Fund. And according to a Business Day report last year, only about 45,000 people have benefited. So 45,000 people is a drop in the ocean in terms of what people really need to cope in this period. And there's import duty waivers on importation of items, materials, and products to fight COVID-19. And what they haven't added is VAT exemption, because it's not only import duty, VAT is also important. And there's a second bill to try and provide free electricity to Nigerians for 2 months. Many of us think that this one is just a waste of everybody's time. I'm not sure there's any Nigerian who says their number 1 priority now is free electricity. People really just want electricity and they want to pay for it. The other interventions we have seen cut across immigration, travel restriction, visa on arrival is suspended. NITDA extending the period for filing data protection compliance report. NCC, very importantly, clarifying that 5G has nothing to do with COVID-19. Then SEC also extending some filing deadlines. Then other economic policy responses, I think the point I would just highlight here is the fact that the pump price of petrol has been reduced from 145 initially to 125 and now to 123.50. Some of us think that government, should just fully deregulate and also take into consideration all the subsidies, because oil subsidy, petrol in particular, had three components. There was a component about FX, so they were getting a foreign exchange at a lower rate than the rest of us. Number two was tax subsidy. So all the taxes that are supposed to be on petrol were not imposed, including VAT, import duties, and other levies. And number three is the cost under recovery by the NMPC. So if government is trying to deregulate now, they just need to hands off and consider all of those subsidies. This would be a very good way to show up government revenue without really increasing the burden on the poorest people, because really people who are enjoying the benefits of the subsidy were mostly the middle class and the upper class. So in closing, I'm going to speak to the opportunities and then I'll share my closing thoughts because on one hand, people can keep focusing on what's not working well during this period and not see the opportunities that are in there within even the crisis. So the first one is around business continuity strategy and your tax consideration. So we're facing business disruption. There's no doubt about that. You need to think about what do you do with impairment from a tax point of view and debt. Should you be thinking about restructuring of your finance function or even tax function as well? You need to consider tax cash flow planning. It's going to be very painful for you to report accounting losses, and then the taxman says, "We're sorry, you have a taxable profit and you have to pay tax." Then you have to then go and borrow to pay government while you're struggling to even stay afloat. So those cash flow planning from a tax point of view will be very important, including how do you manage your tax attributes, deductions, credits, and so on and so forth. For cross-border, for companies that are they have presence outside Nigeria, like a number of banks have branches abroad or subsidiaries. You need to track what they're doing. This is not just a head office matter. We know this is a global issue. You need to track what they're doing. How are the laws changing? Are they looking at what affects their compliance? Must still be 100%. And then more importantly, take advantage of the relief that government is providing to optimize your position. We have global mobility for a number of people are stuck in places they never planned to be, and then they're working remotely. So in tax balance, this can easily create what we call permanent establishment for the organization. So you need to track the laws in those countries. A number of countries have made exceptions to say if you are stuck in a territory for this period, we'll waive the provision of tax residency and permanent establishment. Then we have other areas where you can also consider those planning. So opportunities for business continuity and post-COVID-19 competitiveness is important. So as you think about dealing with COVID-19 period, also think about what happens post-COVID-19. Think about your competitive advantage, think about how agile. So some of us are beginning to see the areas where we're vulnerable that we never considered before. There are teams who never allowed everybody to work from home. So working from home was a luxury before. Now it's a business continuity issue. So you have to think about, some of us also realize that the internet we thought we had, were not really good enough. So also issues around cash flow management, eliminating waste. You need to review contract now and say instead of maybe for example you have utility supplies, you have consumables. This might be small. Some of them are big. You may have rental in offices that you really don't use. Maybe this is the time to cut down on those overheads and gain some efficiency. So my slide talks about strategic responses by business leaders. Don't just worry, take steps and address the challenges you face. Capitalize on the opportunities presented. I put this one under 5 categories. One is your workforce. Protect yourself, protect your staff, and plan on how to stay safe, stay sane, and stay productive. Then your operations, you need to consider how do you maintain the supply chain, services, products, supplies, inputs. Communication, do not panic. Stay informed and provide clarity to your stakeholders. Many companies will be relying on the CFO for the financial stakeholder communication. Provide insights. What are you seeing in terms of your customers' behavior, and what can you learn from that and do better? Then in terms of your brand, it's important. So even what you say now, for example, officially, and how you communicate to your staff, to your customers, to regulators, can have an impact on your brand, positive or negative. So you need to be mindful of that. Then I like this quote as I close by John F. Kennedy, who says that the Chinese use 2 broad strokes to write the word crisis. One broad stroke stands for danger, the other for opportunity. In a crisis, be aware of the danger, but recognize the opportunity. I think this slide just nicely summarizes, what I've been saying. The crisis is there, that's a fact, but there are also opportunities. We need to manage the crisis and then take advantage of the opportunities. At PwC, we have a mobile app. It's called Tax 247. Essentially has tax laws, decided cases, circulars, tax alerts. You find over 50 tax laws there. What we have done as part of our, responsibility and trying to support people at this difficult time is we have included a module, on COVID-19. So from the app, you see COVID-19 resources. So all the things that are going on around from, the state to federal government, right, left, and center, you can see them in one single place. And we're also working on the Knowledge Hub from our website, where you can see navigators, you can see what's happening in over more than 120 countries worldwide. All of these are our own way of trying to help in this, difficult and challenging time. So that's all that I have for now. So thank you very much. I'll pass this on now to Ken to continue with the session, and I'll take questions later.
Thank you very much for all the subject matter experts and the excellent presentation. So I'm sure that the participants are having a great time, hearing some of these things, which they're now putting more into perspective in relation to their specific companies. We're quickly going to go into the Q&A session, where we'll be directing questions to the subject matter experts for their comments or reaction. So I'm going to start with the first question. And this question is directed to Bolanle. And it says, how detailed should the disclosures in Q1 interim reporting be? So how detailed should it be? And maybe just to tie into that, so that you can deal with the two questions at the same time. There is another question here which says, relating to subsequent events to the 2019 financial year accounts for organizations that have concluded their financial year audit. If I get you right, do these firms need to update the audited financial statements with subsequent event disclosures? So this question is directed at Bolanle, and Sam can make one or two comments in addition.
For the second one, if you haven't filed your financial statements, you haven't signed it, or you may have finished your December, the auditors have not signed it off, you will have to have a subsequent event note and detailing what's going on with COVID, how it affects you, both the quantitative and the qualitative impact. If you do not know the quantitative impact, you can state there that you are still assessing it. However, to accept it, you will be expected to say certain things like how it affects your customer, how it directly or indirectly affects your business as well. So if you haven't done it. If you have already signed off and filed your financials, December 2019 has gone, you need to focus on your next reporting period. Now, for the disclosures around interim. Now, interim report disclosures are governed by paragraph 15 of IS 34, and it talks about there are some key disclosures that it requires. So disclosures around risk management, you will have to put it in there. Disclosures around additional requirements like segment reporting, business combination, any significant details to help users of the financial statement. So the detail will depend on your users. Bear in mind what you want to tell them. The truth about it is that COVID and its impact is quite complex, so you have to plan the disclosures. There are a number of publications that we as PwC have already issued to help interim reporters. So you can find them on our www.pwc.com website. It's in there. And if you want it, I can also share it afterwards. I thought I'd give you some key 5 areas that you can sort of document as well. So it really depends on your users of financials, but there's some mandatory ones you must put in, which you can find in paragraph 15 of IAS 34 about the mandatory disclosure. Thank you.
Thank you very much, Bolande. And the next question I have is going to be directed at Taiwo. I heard Taiwo say there is a 50% reduction in pay. If this is true, when is it effective? And will it be considered on payrolls before remitting net pay to staff?
Thank you, Ken. Yeah, so just to clarify, this is not a reduction in PAYE. So PAYE will continue as normal, at least for now. Nothing has been announced in that regard. So this relief, according to the House of Representatives and their draft bill, is meant to grant a rebate to the employer, not to the employee. It's granting a rebate to the employer, but using PAYE as the basis. So in other words, if you keep all your employees from 1st of March, the number you have, 2020, until 31st December 2020 without sacking any of them, of course, they can voluntarily resign, or if they do anything illegal, you can fire them. Other than that, and retirement, then you get that as a rebate. So PAYE is not affected. This is the employer getting some benefit for retaining their employees. But like I said, it's significantly inadequate.
So in terms of the effective date, my assumption is that that would be when it is eventually passed into law, if it is passed into law.
That's correct. So it's been passed by the House of Representatives. It's now waiting for the Senate. After the Senate has passed it, if there's no discrepancies, they will send it to the President for assent. If there are differences, then they have to also harmonize. And then it goes to the President to sign. I think that it has a very slim chances of making it through because it doesn't seem like there was a lot of input from the executive drafting the bill, which is why I also made the point earlier on that this is really the time that all levels of government, all arms of government must work together. This is a national crisis, and it has to be handled as such. So I think what's going to happen to the bill is it will be withdrawn and maybe revamped, amended, and presented to the National Assembly. So, but again, time is of the essence. We don't see things moving quickly enough.
Thank you very much, Taiwo. The next question I'm going to direct to Bolanle. Typically, organizations do goodwill impairment annually, which means that they typically do it at the end of the year. For interim reporters, would they be required to perform a goodwill impairment assessment at, say, half year, or can they continue to do this at the end of the year?
Thank you. The standard actually says goodwill impairment should be done at least annually, except if there is a trigger of impairment. Now, COVID-19 is a trigger of impairment, so yes, you will need to carry out an impairment assessment. It doesn't, however, mean that you will take an impairment. So it's just for you to carry it out and say that you've carried it out. and then you can talk about it in your significant estimates and judgments. The fact that you have looked at it and there's no impairment to take.
That makes a lot of sense. I'm going to direct another question to Taiwo. And Taiwo mentioned the issue around the Minister of Finance mentioning that deductions will be granted for COVID-19 donations. Does this deductibility cover, direct donations by organizations to any intervention, or are there specific interventions that are covered by that comment from the Minister of Finance? And how much reliance can organizations place on that comment coming out from the ministry?
All right, thank you very much. Can you hear me, Ken?
Yes, I can hear you very clearly, Taiwo.
Okay, great. So you're right. So that exemption, deduction that the Honorable Minister announced is meant to cover any fund established by the government or approved by the government. So this is actually riding on the back of a provision in the Companies Income Tax Act. So for a natural disaster and all of that, so the minister is empowered to issue an order. That order hasn't been issued, but I can tell that it will only be applicable to the fund approved by government. So we think that some of the very high-profile ones, like COVID, the coalition against COVID-19, is being championed by the CBN and organized private sector, most likely will get the blessings of government for the deductions. As we speak, that is not yet in place because the legal formalities haven't been concluded. So we'd encourage organizations who want to donate to make sure that they, channel their donations towards established funds that are likely to enjoy these benefits. Otherwise, you usually lose the benefit of about 32% on your donations.
Thank you very much, Taiwo, for that. I'll just direct this question to you. What trends are we seeing in terms of fiscal policy and tax measures across Africa? I know the Africa Tax Administration Forum put out a publication recently around what tax administrations and tax authorities should be doing. But what are some of the trends you've seen in terms of Africa?
Yeah, thanks, Ken. So what we're seeing, again, because Africa, maybe, I don't know whether it's the right thing to say, so far we have been fortunate because the number of cases in the whole of Africa, for example, is less than what you have in the UK alone. But I don't know whether this is something that will remain like that and start to come down, but hopefully it doesn't go up because we think that Africa is the least resourced to deal with a pandemic on a large scale. So what we're seeing across Africa is also a reflection of the level of the exposure that we have to COVID-19. So most of the countries are mostly just extending the deadline for filing returns. A few countries, such as South Africa, have gone ahead to introduce a number of other reliefs like employment relief incentives. So what they actually do in South Africa is that by keeping your employees, you get money in the bank every month. So they used to pay these incentives twice a year. And because of COVID-19, it's now once a month. And that makes sense to me because really, the biggest challenge that companies have now in retaining their employees is money to pay them. So you really need money in the bank. So other than that, we have the ATAP, that's the Administration Tax Authorities Forum. And they're simply just recommending, what I would say is the global standard. Issues to do with delaying payments, suspending tax audit because you don't want to put any extra burden or pressure on taxpayers and businesses at this time. And then in addition to that, ensuring that there are protocols for communication and enhancing online services for taxpayers to remain connected to government. So these are some of the pattern and the trends we are seeing across Africa, which is likely going to change as this thing develops.
Thank you very much, Taiwo, for that. My next question is directed to Bolanle, and I took one phrase from her presentation, which is plan the story and tell the story. But for something like IFRS 9, where you have to look at the expected credit loss model, how easy is it for companies and organizations to predict the expected outcome of COVID-19? What sort of reports or models would they be looking at to help them to properly value their impairment allowances?
Thank you, Kenneth, for that question. The truth about it is that it's not one size fits all, which is why I talked about scenario analysis. You have to, the measurement principles are still the same. So there are a number of things that go into the IFRS 9 model calculation. So for example, your recoveries. You will need to look at the cash recoveries so far and going forward for your entries, looking at the cash flows. You will need to look at the combination of macroeconomic factors. So if inflation is at 12% versus it is at 9.8%, look at Forex. If there's a 30% devaluation in Forex, what does that mean? You of course need to look at your your exposure at default. So what is your exposure? You look at the value of collateral. So you will need to look at it. Best case scenario, worst case scenario. What does that mean for you? Looking at segregation, the way you segregated your portfolio, because truth about it is some portfolios will be affected. Looking at the effect of government reliefs and interventions as well. Even looking at your own risk management policies. So, for example, there are some financial institutions that will fare better because their concentration is not necessarily on the retail sector or the corporate sector. They have a different concentration. So they will probably fare better. So it really depends, which is why we said you need to plan the story, you need to look at it, and we've asked people to recalibrate their models. Then looking at modification of loans as well. So it's actually quite a big exercise, which is why, Sam has said, as an auditor, one of the things they're encouraging people to do is get help so that you can do it now and plan it ahead instead of waiting until later. And then, of course, the disclosures attached to it as well.
Thank you very much, Bolanle. There's one final question which I have, and I don't know how to really coin this question. With COVID-19, you might find a situation where regulatory ratios are a challenge to comply with, and some of the things which have accounting impact may not necessarily be deductible for tax purposes. Is there any scope for the industry to engage regulators and tax authorities to look at some reliefs with regards to compliance with regulatory ratios, or even taking a deduction for something like impairment losses? And my question is directed to you and to Taiwo, Bolanle and Taiwo. So maybe Bolanle should or Taiwo should go first, and then Bolanle can go next.
Okay, thank you, Ken. Yeah, so I think this is a very valid question actually. So you're going to have a lot of challenges that nobody planned for before, and some of it will start by being an accounting problem, and then they translate into other problems, including regulatory ratios and tax. So clearly, the answer is we need to come together. This is a problem for everyone, and governments would understand if you have, platforms that you use rather than trying to engage individually. Once you make that business case to government to say, one, you need to protect us so we continue in business, There's no point saying we fall below a ratio or regulatory ratio and then you close us down. Then who's going to pay the taxes? Who's going to employ the people? So when you go like that, let's develop, analysis, look for best case scenarios around the world in terms of, what other countries are doing in terms of best practices. Once we table this before government, I'm more than confident that they will consider this. So those engagements need to happen, but before then, the thoughts around all the issues that we need to analyze and have the options for dealing with them need to start now, so that those engagements can happen quickly before any damage is done.
Thank you, Harry. From my point of view, one of the things to just bear in mind is that IFRS 9, for example, and in some cases, allows some overlays when you're doing some of your calculations, and some of these overlays may be as a result of this government regulations and ratios and things that you need to do. So as you are going through the process of making this analysis and changes as a result of COVID, and you have to take into account all these regulatory impacts, you can also put some overlays in there. However, whatever you do, you must be able to justify it and document it. In addition, Taiwo is right about the fact that we all need to come together and have the conversation. It's just that sometimes it's a bit slow, sometimes trying to get approvals for certain adjustments. However, it's still possible, but just bear in mind that IFRS does recognize that in some countries you do have some limitations with regards to regulatory requirements and ratios and all that. So apply the overlays, but whatever you do, please ensure that you document it and you have justification for using it.
Thank you. Thank you very much for the feedback, and thank you everyone who contributed and asked questions. Just one comment, because there were some questions raised around, would we get access to the recorded version of the webinar, or would we get access to the slides? And the answer is yes. We would also communicate with you using the email addresses which you used to register, to give you the link to our website when we've uploaded the slides and the recording onto the website. So thank you very much. With that, I'm going to hand over to Doyin Amosun to take over the next segment, which is on the survey.
Thanks, Kenneth. Good morning, all. It's great to be here. I will be presenting the highlights of the COVID-19 survey for CFOs, finance, and tax managers. The survey was completed by finance function executives across the financial services industry, including banking, insurance, asset management, and pension sectors. I'll now go into the findings from the survey. About 33% of the respondents estimate that the impact of the pandemic will last for 3 to 6 months. An equal number of respondents, in this case about 28%, are of the view that it will last for 6 to 12 months and over 1 year. While some respondents are concerned about the negative impact of the pandemic on their organization's financial performance, about 30% of the respondents believe that it is difficult to foresee the impact of the pandemic at this time. Going on, in terms of the key concerns, the number one concern for most finance executives is the negative macroeconomic impact of the pandemic. And this is expected, considering that the IMF has estimated Nigeria's real GDP growth at minus 3.5% for this year. Now, going on to other key concerns. Finance executives are also concerned about market volatility and reduced productivity, i.e. the reduced productivity of their workforce. 44% of finance function respondents estimate that their organizations will return to full operations within 3 months, while about 32% estimate that post-pandemic recovery will be within a month. Perhaps these timelines are indicative of their perception of the resilience of their organization's crisis management and recovery plans, in addition to their views in terms of the speed of economic rebound. I guess time will tell in terms of which one it is. In terms of disclosures, half of the respondents are undecided if there will be changes to disclosures in the financial statements. Basically, these respondents believe that it's an uncharted territory that requires some time to articulate a response. It will be interesting to note their response now following Bolanle's session. 20% of respondents will maintain status quo, i.e., they will make no change to the disclosures in their financial statements, while 17% of finance executives indicate there will be some changes to the disclosures they make on their financial statements. Interestingly, just about 12% of respondents indicate there will be significant changes to disclosures in their financial statements. The survey results and the recording of this session will be available on the PwC website. On this note, I'll hand over to Kenneth to close the session. Thank you and stay safe.
Thank you very much, Dwayne, and thank you everyone, to the subject matter experts. Thank you, Andrew, for a very concise and very insightful opening remark. Thank you to all participants who joined in, and thank you for making the contributions which you did. With that, we'll wrap up this webinar, and I wish you a wonderful week, and I wish you and your family keep safe. Thank you very much. Cheers and bye.